The Fed announced that they are not going to do a rate cut for the foreseeable future. Is that good or bad for mortgage rates? Well, most likely it's pretty good. Anyways, check out this video. Hello, my name is Mike Florin. I'm the owner of Low Cost Mortgage. Today is your weekly update for February 5th, 2025. Rates have come down for the last few weeks. I'm going to cut to a little video I did. We're doing screen share now, or screen capture. That way you can actually show with you live where things are instead of popping up charts on the screen. Okay, so it was recently announced that the Fed was not going to decrease their rate for the foreseeable future. Well, that's probably not a terrible thing for interest rates, and let me show you why. Here we got our T-bill. This is 2 days of data. Not really much here. Down and flat, down and flat. Okay, we're going to look at the 1 year. And I might say the same thing a few times. Just bear with me here. All right, so you've got in March of last year, 2024, rates were okay. They're fairly stable for that period of time, February, March, a little up, a little down. It comes up and over for May, April, May of 2024. So we saw that seasonality going up. It peaked, it leveled off, and it started to come down. It was a nice slow downward trend, a little up and a little down, but for the most part, a downward trend, all the way to right here, September of 2024. Now, before the pandemic, interest rates for government, we're just going to speak purely government loans, okay? We were low fours for government. Now, in September, right here where the cursor is, of 2024, we were in the high fours. Now, that was without the Fed changing anything. That was with the Fed rate being where it was for a very long time. Well, guess what happened in September of 2024? And then the Fed decided they were going to cut their rate. When the Fed cut their rate, what happened is an upward pressure on interest rates. So the Fed cuts theirs an eighth to a quarter. Mortgage interest rates skyrocket, and they go up from September of 2024 all the way up through November. This nice little upward, pretty dramatic upward movement in rates. So we've got November of 2024. Rates are now the second highest that they've been in a while, and everyone's a little panicky. Well, seasonality pushes in a little bit of data. It also stabilized. Cash flows have stabilized. Investors have stabilized with the new information, the new way of doing business, or the way they want to manage their cash. Rates started to come back down again. There's also data in there too. Well, guess what happened in December? The Fed cut the rate again. And what happened to rates? Rates went up. It went up quite a bit. And it went up to the second highest point it has been in 5 years. And that was after 2 Fed rate cuts. Now you see some stabilization, and it's starting to come back down again. Now this high point was January of this year. That was just a few weeks ago, about a month ago. But now we're seeing a downward trend in rate. So if the Fed were to decrease their rate, most likely you would see an increase in mortgage rates. So what do we want the Fed to do for the mortgage side, for the real estate side? Well, probably nothing. I can't say for certain that nothing would be good, but it certainly shows in this last year when they did nothing, rates were downward trending. Now, there was some data in there to show why, but there were some investors that were moving money around based on information they perceived and everything else. Let's look at the 5-year chart. And this will really put it into perspective. These are the pandemic lows, right? 2020, 2021. So down here, rates are in the 2s. You can't quite see that in your chart because I'm in the way. Sorry about that. It comes up and now it's in the 3s. Then the Fed decided we need to stop inflation. So they're going to start increasing the Fed rate. And it did exactly what it was going to do. It brought it up. Now the Fed stopped increasing their rates. Rates came up, stabilized, and came back down. This is October of 23. Then came back up, stabilized, and then came back down. And this right here is where we see the Fed decreasing their rate. Rate shot up again, back down. Fed decreases the rate again. Mortgage rates shot back up again, leveled off, coming back down. So if the Fed does nothing for the next few months, you should see rates come down for the next few months. Now, as you can see from that, I cut in a few different bits of information there, but at the same time, in summary, every time the Fed decreased their rates, rates went up. If the Fed does not decrease their rate or kept rates the same, rates went all the way down into the high 4s for government, which was great. It was a great thing to do. So in all reality, is the Fed not cutting rates a good thing? Probably so. You'll probably see some stability. You'll see some investors competing with each other. And the big key thing on mortgages is different investors, when they start competing, because they still need to bring in deals so they can pay their head count, make money and everything else. If the T-bill stays relatively the same, or the T-bill does what it does, and then the investors themselves are not seeing the loan volume that they want to see, the easiest way for them to increase loan volume is decrease rates. So if the investor is decreasing rates or finding ways to make things more streamlined, finding ways to get more money out of a deal and lowering rates so that way they can get more deals in, that's what they're going to do. And that's called competition, and that's what makes it so good. That's why sometimes you're going to see rates not follow the T-bill. It just kind of depends. Now, as a realtor, remember, I used to be one about 20 years ago. I have some awards from it, did some decent sales, you know, whatever it was, right? With that being said, as a realtor, and I deal with a lot of realtors right now, my network is over 700 realtors. And there's one common theme, one common thing that the producers are constantly doing, and that is always looking for the next deal. Like I'm always looking for the next deal, and I coach my loan officers, hey, you're always looking, where's the next deal, where's the next deal, where's the next deal? In real estate, it's really important. Your number one priority is lead generation, always looking for the next deal. So between now and a few weeks from now, hopefully you go out and you find another deal, another deal, another deal. Always be working those deals. That's key in real estate. As for current interest rates, I'm not going to quote rates anymore in the video. I can do it. The problem is it takes a little bit of time and there's no real reason for it when you can search rates live, or just give us a call and we'll give you a quick quote of where you are. But traditionally, typically, oh, by the way, you're going to go to lcmloans.com/rates. It's really simple. The rates on there are 1/8 to 1/4% higher than what you're most likely going to see based on your scenario. Most likely, okay? Now, typically where low-cost mortgage is we're cheaper for the same rate. Low cost. So for the same interest rate, our cost is typically $8,000, $9,000, $10,000, $12,000 cheaper than the next competitor. Now I'm going to start a little series up where we take other competitors' loan estimates and fees worksheets and we compare them apples to apples against us. And you're going to see, very simply, that low-cost mortgage is by far the better deal. Now, are we the better deal in every single deal and every single loan we find? No, not every single loan. There's a reason for that. This is funny. This is something realtors really don't know. If a loan officer at a company, this is why the financial industry is so, I want to say it, fiscally conservative and rule conservative, right? And that's because if a loan officer at a company screws something up and gets a loan estimate out there with the wrong information on it, and it ends up costing that mortgage company money, that mortgage company has to close on that deal and they have to eat it. Now, you as a realtor, you might see, oh, but this person, closed this deal. Well, if it's not compliant, they just created an unsellable loan. That mortgage company lost a lot of money, but they still have to close it, right? With that being said, what I'm seeing is the people that are beating us in rate and cost of rate, that competition that we're always in, the ones that are typically the loan officers not paying attention and quoting the wrong program. So for example, an investment property being quoted as home ready. You can't do that. The other big thing I'm seeing is they will not quote correctly and get it out with the wrong numbers on it and say, oops. And the company still has to pay them. It still has to do its thing. It's kind of ridiculous. I want to say the last one is there's companies that are losing money on purpose on a loan just to beat us to try to capture it, which is good. I like to see that. So hopefully more mortgage companies will start lowering their rates. So in essence, not every single time we're the cheapest, but pretty dang close to almost every time. But anyways, my name is Mike Florin. Have a great day. Have a great week. Have a great month. I'll see you guys later.